personally speak to a lot of large corporate entities or banks, and they've made it clear that the recent kind of like the combination of the spot Bitcoin ETF being allowed and then also the Trump victory just increased their confidence that they have a pretty long window now of the government not really being an issue with them holding Bitcoin. So any sort of tail risk concerns some of those had have been reduced. So if that was someone's hang up for not buying, now they can buy. And I think that's why we've seen liquidity's not really gotten much better since the election, but certainly the regulatory outlook for the space has gotten better. And so that's why I think we've seen a pretty rational price increase.
Alden begins by analyzing the Federal Reserve's monetary policy and its potential impact on asset prices. She notes that the Fed has already tapered its balance sheet reduction, slowing its quantitative tightening. Given the limited sources of liquidity available in the financial system, further tightening could create stress in the Treasury market, which would then spill over into other markets. If the Fed were to aggressively continue its balance sheet reduction, it could trigger instability, prompting them to reverse course and resume liquidity injections.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
All else being equal, that would be tighter monetary policy at a time when there's not really as many offsets anymore. So yes, I would think that'd be negative for asset prices. If anything, they're going to go in the other direction. So they've already tapered, like they already decreased the rate that they let treasuries mature off their balance sheet. So they've slowed down their quantitative tightening. Probably the next step is to slow it down more or stop it altogether, which we might see by the end of this year. And over the past couple of years, we've had the $2 trillion reverse repo facility drain back into the system and offset their quantitative tightening. That's now down to like 100 billion, so that can't happen again. And so there's not that many other sources of liquidity. So yeah, if the Fed got super aggressive with balance sheet reduction, I think we probably would see some challenges in the treasury market, and then that would then bleed into other markets, and we probably would see a backpedaling by some of these entities, mainly the Fed. Yeah, anything that increases regulatory certainty is helpful. So I personally speak to a lot of large corporate entities or banks, and they've made it clear that the recent kind of like the combination of the spot Bitcoin ETF being allowed and then also the Trump victory just increased their confidence that they have a pretty long window now of the government not really being an issue with them holding Bitcoin. So any sort of tail risk concerns some of those had have been reduced. So if that was someone's hang up for not buying, now they can buy. And I think that's why we've seen liquidity's not really gotten much better since the election, but certainly the regulatory outlook for the space has gotten better. And so that's why I think we've seen a pretty rational price increase. If the U.S. does a really big Bitcoin purchase, that's obviously generally good for Bitcoin. If they just do a small purchase or they kind of keep the coins they already have, then maybe that's not a big factor. But if they do some of the more aggressive ones, that could be big. If other central banks or other sovereign wealth funds decide to accumulate meaningful positions, that matters. There's a little bit of a spreading of corporations buying Bitcoin. And so to the extent that accelerates or decelerates, that's really meaningful for price. So there are tons of non-liquidity things, like they're kind of more cultural or regulatory things that can happen. And then the other thing I look at is mainly like just on-chain valuation metrics to look for problem areas. My favorite metric is market capitalization compared to on-chain cost basis. And right now that's pretty middling. So it's not as high as it historically has been during major market tops. That's not to say that every cycle has to be the same. They could certainly change. But most of those like types of kind of fundamental valuation indicators or like kind of euphoria indicators are still not really flashing red. At a couple times they've kind of flashed like yellow, but they've not really been flashing red. which is another set of things that kind of gives me confidence for the next 18 months or so. It's been positive to see this consolidation kind of work its way out. I probably thought the consolidation would last a little longer. I'm glad it's not because I'm long gold. Generally speaking, we've seen a little bit of rotation in buying. So before it was mainly foreign central banks and people in China and elsewhere buying. Now I think we're seeing a little bit more North American purchases that are supporting it. And a main difference between gold and silver is a lot of large entities like central banks buy gold, whereas they don't really buy silver. In addition, generally speaking, if someone is into like hard money and precious metals, gold's the low volatility one, and then they get into either silver, platinum, or miners for their higher volatility exposure if they're bullish on the space. And now, with the size of Bitcoin and to some extent other cryptocurrencies, that market's more fractured now. So I would say that Bitcoin has not really competed with gold too much because it's not really competing with the same types of buyers. Now, around the margins, it has competed, but I would say it's competed with silver and gold miners more because you're capturing kind of a hard money enthusiast with high volatility tolerance. That's a little bit more of a competing market. So I think that the options for higher volatility is a little bit more fragmented. So I'm not surprised too much to see gold kind of have a bigger breakout than say platinum or silver or the miners. And I still think long term this has room to run because central banks around the world can say I'd like to hold assets that are not seizable unless like we're literally invaded. Also, I just think that there's more and more currencies having problems. I mean, the euro currency doesn't look structurally good. We already talked about U.S. fiscal dominance, Canada's currency, China's currency. I mean, around the board, gold looks pretty attractive compared to most currencies. And so it's not surprising that a lot of entities buy it.
Alden provides a detailed framework for assessing global liquidity, a crucial factor in asset price movements. She explains that liquidity can be measured through metrics like broad money supply growth and the strength of the U.S. dollar. A strong dollar can create stress for countries with dollar-denominated debt, whereas a weaker dollar eases liquidity conditions globally. She traces the liquidity cycle from the expansive policies of 2020-2021 to the tightening phase of 2022, followed by a recovery in 2023-2024. As we move into 2025, the liquidity environment appears favorable for asset prices, but investors must remain vigilant for potential shifts in central bank policies and fiscal dynamics.
They don't need lower rates. It depends what else is happening. They certainly, the cost of capital is a major input for valuation. But I mean, right now, for example, Costco is trading at like 60 times earnings, despite rates being historically high still for the modern investor time frame. So clearly, it's not like a one-to-one correlation where higher rates means lower asset valuations. There's even certain environments, and this you normally see in emerging markets, which is that higher rates can actually fuel higher asset prices because you blow out the deficit even more. And so I would actually relate things like money supply growth to asset prices more than rates per se. I think the current environment is kind of a mix for asset prices. Because on one hand, the high rates are increasing the deficit because all that interest expense is flowing out to a lot of private entities and foreign entities that own that debt and able to spend that interest, either accumulating more assets or going out and accumulating goods and services. So that's generally inflationary for asset prices. But the higher rates do put headwinds against how much you can reasonably pay for equities, because when you start to pay really super high silly valuations, and you actually do have a pretty significant hurdle rate to clear in terms of the cost of capital, it keeps somewhat of a lid on that, and I think some of those really high valuation equities are at risk if we stay higher for longer. There are a lot of really cheap equities both in the U.S. and internationally, and some of these policies could be better for them than we think. I mean, if you generally have, on average, sticky high inflation, some degree of deregulation, Trump putting pressure that he wants lower interest rates, and just in general ongoing fiscal environment, I think probably U.S. banks are going to do better than expected. It's not a very liked asset class. Um, I think emerging markets are interesting right now. Um, Basically, very underallocated. Nobody really wants them. The last thing people want to buy in a trade war is international stuff, but some of those are actually not that affected, in my view. Um, and so I still think mid equities, there's actually still a lot of opportunity out there. It's not like when people see the expensive U.S. market, they'll look at like market cap to GDP or the CAPE ratio. That's a collection of thousands of stocks, and there's actually plenty of areas that are trading at very normal valuations and that, in my view, still offer better return potential than bonds. The simplest one, which is global dollar-denominated M2, so global broad money supply denominated in dollars. It's not perfect, but it's reproducible, which I think it's really useful. There are proprietary ones that are also great. I mean, Michael Howell of Cross Border Capital has he's kind of like the liquidity guru. Tons of great analysis there. So I think there's multiple reasonable ways to define liquidity, but basically what you're looking at is, domestically speaking, is broad money supply growth happening or not, and where are the sources of it coming from? Is it from bank lending or is it from fiscal deficits? Those are kind of the two main sources. And then two, what does the international situation look like? Because if the dollar gets really strong, then all the dollar indebted entities around the world get generally squeezed because their liabilities are hardening relative to their cash flows. On the other hand, if the dollar eases, generally speaking, that's like easing their liabilities compared to their cash flows. And so some combination of the quantity of money and then also specifically the dollar in relation to other currencies, and the way to kind of put that together, the composite, is to say what is global broad money when you then translate into dollars, because then you can map out the various magnitudes of those things. So if the dollar is strengthening, but the money supply is going up rapidly in a bunch of countries, then maybe that second factor is a bigger positive component than the strong dollar. So you kind of put those together and see what is the general direction. And we've generally been in, 2022 was really negative for liquidity. So, 2020 and 2021 were like super across the board amazing for liquidity. Then 2022 really negative for liquidity. And then 2023 and 2024 were like recovering from that negative liquidity environment, and still good enough liquidity to be pretty good for attractive assets. And so far, that seems to be the case in 2025 as well. And basically, these things are moving around more, and therefore, any asset that's correlated with liquidity is going to be more correlated with other assets that have that similar component, because liquidity is just such a big factor in this kind of post-COVID or like fiscal dominant environment.
Alden identifies investment opportunities that align with her analysis. She suggests that U.S. banks may perform better than expected due to a combination of high inflation, fiscal stimulus, and potential interest rate cuts. Additionally, she sees value in emerging markets, which remain underallocated despite attractive valuations. She also highlights the importance of diversifying across assets that benefit from fiscal dominance, such as gold, Bitcoin, and select equities. Her approach underscores the need for investors to focus on structural trends rather than short-term market fluctuations. Please like and subscribe.